What is a recession? While some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way all economists evaluate the state of the business cycle. This is according to a note from the White House. U.S. Treasury Secretary Janet Yellen has also said that though the U.S. economy is slowing down, a recession is not necessarily inevitable. She says that though the risk remains, it can be avoided. With the inversion of bond yields curve, a curious data point is also important. In the last 100 years, whenever the curve has inverted, the U.S. economy has been hit by recession in the next 9 to 22 months. Now, GDP is not the sole criteria, according to the White House, for decoding a recession. But does that mean that the United States economy is out of the woods? Why do we care? Because obviously the U.S. economy hitting a recession possibly is bad news for the globe, for the world economy, and for India. To understand the impact of this, I'm joined today by Swaminathan Aiyar, Consulting Editor, ET Now, V.K Vijayakumar, Chief Investment Strategist, Geojit Financial Services, with us on the show. I'm speaking with Ajay Bagga, Chairman of Elements Platform, and market expert Peter Cardillo, Chief Market Economist, Spartan Capital. Welcome to all of you. Thank you so much for speaking with us today. Peter, let me begin with your take on the kind of commentary which has come in over the last couple of days on the definition of recession. I want to start with that point. Do you get a sense that the government in the United States is trying to downplay fears of recession?
Absolutely. There's no question about that. Look, from a textbook standpoint, if you have 2 quarters of negative economic activity, basically you're in a recession. Now, the question is, what kind of a recession? Is it a mild recession, a long-lasting one, a steep recession that we had back in 2002, 2008, 2009? That's yet to be seen. But from what I gather, and as we analyze the macro data that's been coming in, we're headed for a recession. The question is, is it going to be a steep one, a mild one? My guess is that it's going to be a mild recession. A mild recession means that you have 2 negative quarters. You have 2 negative quarters of growth, and you come out of it pretty quickly without major damages.
Okay. Let me go across to Swami. Swami, the whole question of whether the U.S. goes into recession, the kind of positioning that we're seeing before the next crucial GDP data is out, and how worried should we be?
Oh, I think we should be very worried. There are actually 2 recessionary scenarios. The first quarter of this calendar year, the United States economy was minus 1.5% GDP. The second quarter figures aren't out yet. It is possible they will also be negative. That would mean that we have already had a recession in the first half of 2022. But that would be a mild recession from which I would expect there may be some kind of comeback in the third quarter. But beyond that, if the Fed keeps increasing its interest rates, right now it's in the range of 1.5, 1.75, it could go up by another 2 percentage points by the middle of next year. So there is a fear that the Fed raising interest rates will create a much deeper recession by the end of this year or in 2023. So as I said, the current, what has happened in the first half may have been a very, very mild recession, which is not a serious issue. There's been a slowdown in the world economy, no doubt about it. But if this is all, and we now do a little better, it would be a very bearable thing. The real problem we face, what happens down the road, 6 months down, 9 months down the road. It is entirely possible that if the Fed keeps raising interest rates, it can spark a recession in the USA by squeezing activity. At the same time, the rise in interest rates of the Fed can spark an enormous flow of dollars out of all emerging markets. So we would be hit by something different. Not only a fall in demand, we would also be hit by a huge exodus of dollars out of emerging markets. That will create other problems. The exchange rate will go down, our imported inflation will go up, and we will feel even more the need to raise interest rates. So as I said, whatever has happened in the first half of 22, it's a fairly mild thing. And that is, in a sense, behind us. But looking ahead in the next 6-9 months, if we get another deep recession, which is a possibility but not a certainty, if we get that deep recession, there will be a lot of trouble for us.
So is a deep recession coming is the question now. Ajay Bagga, some of the reasoning given to sort of allay fears of a recession in the United States is the employment data. They're saying that, well, look at the jobs data. It's not like unemployment numbers are zooming. So why the fears of a recession? Where do you weigh in on this debate?
It's not a recession. We can't stick to the technical definition. Go back to 2008. NBER, announced a recession in December of 2008, and it announced that it had set in a year back. So, this number on Thursday, Tamanna, that's coming, it's going to be minus 1.6 again. The first quarter was revised upwards to minus 1.6. Second quarter, Atlanta Fed does a fantastic study, which has an error rate of 0.3%. Their number is still coming to 1.6 and minus 1.6, and so near, 3 days away, they have nearly 100% accuracy level. So you can expect a minus 1 to minus 1.6, but you have to look beyond the number. The first quarter downturn was because of the trade imbalance, because of inventory pile up by the retailers who were, afraid of the Omicron, leading to further disruptions. And we saw a huge trade imbalance, which had a 2% negative effect on the GDP. This time around, Tamanna, it's the inventory runoff, which is causing this minus 1.6. Unemployment, as you mentioned, 3.6, that's not a recession. 5% is when you will really see a recession. You look at consumer growth month on month, last month coming in at 1%, less than the 1.3% of inflation, but still it's a 1% growth. Third, you look at where the interest rates are. On negative real interest rates, you don't get a recession. So this will not be declared a recession. White House is right in saying we are really hair splitting in calling it a technical recession. It won't be called that because their definition is broader economic conditions, and those don't warrant calling this a recession, which is based more on the inventory and the trade balance going askew. Will the recession come? Definitely. 24 months, the US recession probability is 100%. So Fed will not be able to address such a high inflation without raising rates to a level which will lead to a hard landing. We are not going to escape that. Markets will behave very differently. Markets are always out of phase with the economy. Markets will bottom out before the recession takes strong hold, and markets will recover much before the economic recovery. So markets will be out of phase. Let's not confuse that. Rates will go further. I would be with Lawrence Summers in saying probably we see a terminal rate of at least 5% by the Fed. Again, joker in the pack is quantitative tightening. We don't understand that enough. 2018, it did not work. They had to go into a rate cut very fast. This time around, the credibility is eroded so badly. I think there will be overcompensation and rates will go even further.
Okay, so you're saying two quarters don't make a recession, two swallows don't make a summer, but down the line we're going to be in trouble. Mr. Vijayakumar, you have an interesting take that even if there is a recession in the United States, it's not all bad news for India. Elaborate on that further, please.
Well, whether US goes into a recession or not, it is very clear that the global economy is going to face a big slowdown this year and even next year. The other two pillars of global growth, China at 4.5% GDP growth this year and Eurozone at 2.5 to 2.7, means that even if the US doesn't go into a recession, there will be a sharp global economic slowdown. But then this is going to be a blessing in disguise for India. Of course, India too will be impacted when the global economy slows down. Our exports too will be impacted. We cannot escape from that. But this is good news for India in the sense we will have a fiscal stimulus coming from sharp reduction, correction in crude prices. Crude prices are already down 25% from the peak. Metal prices are down between 20 to 30% from the peak. Palm oil prices are now at a one-year low. Therefore, in India, inflation is coming down. That is one point. Secondly, when crude declines like this, it will act as a fiscal stimulus for the economy. And next year, I have a slightly different take from Mr. Bagga on that. I don't think the Fed will raise interest rates all the way to 5%, because if the US goes into a sharp slowdown or a recession, then the Fed will have to do a pause. They might peak. The Fed's peak rate must be in the region of 3.5 or even less. Already the US 10-year bond yield is declining, and the US dollar index also is signaling that. US dollar index went beyond 109. Now it is in the vicinity of 107.
Right.
Therefore, crude correction is going to be a fiscal stimulus for India in 2022 and 2023 also. Also, it is important to understand that India is an outlier as far as emerging market growth is concerned. You look at the World Bank data on the BRIC economies growth for this year. For India, their projection is 7.5%. Let us take it at the 7.2 or even 7%. For China, it is 4.5%. For Brazil, it is 1.5%. For South Africa, it is 2.1%. For Russia, it is minus 8.9%. So when these BRIC economies are struggling, India is resilient, and our leading indicators like energy production, electricity generation, demand for passenger vehicles and commercial vehicles, bank credit growth, all these are looking up. And therefore, India can weather this storm and benefit from the decline in energy prices and commodity prices.
Mr. Bagga, your response to that, it's not going to be so bad, India will be better off, and Fed is not going to go as high as 5%.
Yeah, that's a point of view. Nobody knows the future, so I respect his point of view. We have seen in 2008, when the US sneezes, the world catches a cold. We were talking of decoupling at that time also. In fact, Indian markets went down 60%, Indian economy went down, and the measures that were taken led to double-digit inflation. Now, the situation is very different, Tamanna. You had $19 trillion of fiscal and monetary stimulus in global economies in 2020. It went down to $10 trillion in 2021. This year, in the first 6 months, it's minus $2 trillion. So the quantitative tightening is the joker in the pack because it's happening across 3-4 major economic blocks. India has also been sucking out liquidity. I'm not very sanguine about the economic prospects. Yes, India will have very strong growth, but we are not an island. Exports definitely, and then flows. What Swami mentioned, the dollar strength and the safe haven status, the carry trade, which has got disrupted in the first 6 months, all those flows will link up the Indian economy. I'm not saying we'll have a degrowth, but we will have difficult times, and markets definitely will, markets are forward-looking. They will discount it 6 months earlier in terms of what is going to happen economically. I think there's a hard landing coming in the US, and the world will have to go along and pay a price. Europe remains very fragile with the Russian energy issues. Just now, about half an hour back, Gazprom has announced another cut in the gas supplies. So that could lead to 4 to 6% degrowth in Europe itself. So we really don't know which part of the domino will start it, but things are not looking good economically. I don't think we'll have a soft landing. We're going to have a hard landing for the global economy.
Let me get in, Swami, on this. So hard landing for the global economy, everyone's going to be in trouble, obviously, relative India impact.
Okay, there is not the slightest chance that the world has a hard landing and India does not. We are more integrated with the global economy, I think, than most people think, far more. And we are still a very small part of the global economy. If you were 30-40%, you could say we will hold up. We are only 7% of the part of the global economy. The idea that we will stand out when everybody else is, to me, is a fantasy. I will, however, say that it is possible that the world itself has a soft landing. So if the world has a soft landing, India could. If the world has a hard landing, I am sure India will. I think you need to add that while in good times, India looks much better than other emerging markets. If panic sets in, panic affects all emerging markets. Because when money starts to flow out of emerging markets, there are a large number of funds dedicated to emerging markets, and those are not India specific. So money will flow out from everywhere, including India. So right now, already we are suffering from imported inflation because the rupee has depreciated against the dollar, gone from 74 to 80. You have a huge panicky exit, it goes from 80 to 90. That itself causes so much additional inflation in India. So, the idea that all is well, okay, suppose China ends all the lockdowns, suppose there is peace in Ukraine, everything returns to normal. Can the world suddenly look nice and sunny? It is a possibility, although I don't think it is probable. On the other hand, two things can happen. The Russian sanctions and the war can deepen. There can be further cuts, and this time the West may actually really cut off oil consumption from Russia. On that scenario, I think it was Goldman Sachs suggesting the oil price might go to $280, $300 a barrel. On the other hand, Citibank says that if there is a deep recession and demand disappears, the price of oil may fall all the way to $65 and perhaps further to even to $45.
But that's good for us, isn't it? Swami, that's good for us.
The possibilities is huge. But I personally say you must hope for the best. You must prepare for the worst.
Yeah. Peter Cardillo, so the message coming in from Janet Yellen is that a recession is not inevitable. Do you share that optimism?
No, I don't, because we have to realize that this recession is basically going to be attributed to the Fed. This is a Fed recession. The only way that they can really bring down inflation, by the way, I think inflation has peaked, but it'll take a long time to get to 2% again. So the only way they can ensure inflation to begin to come down, and it'll be a gradual decline, is to induce a recession. And that's exactly what they're going to do. Now, look, you have to remember that interest rates are rising and they're coming off of 0 percentage point. So the plan by the Fed, at least that's what they say, is to get back to normality, which is between 3 and 3.5%, which means that if they go beyond that, then we could be looking at a serious, deep recession. If they just raise to 3 to 3.5%, which I think that's what they're going to do, because the problem is, looking forward, if we wind up in a deep recession, we're not going to be worried about inflation. We're not going to be worried about stagflation. We're going to be worried about deflation. And so the Fed would be forced to really cut interest rates and go back to 0. And I don't think they're going to do that. So I think we're looking at 3.5% maximum, which means a 75 basis point hike this Wednesday, 50 basis point hike in September, and then most likely a pause.
All right. So tough times could be coming in as we prep for whatever is happening next with the US Fed. That data is going to come out soon. And we really have to see what it means for us. But, we've been talking all of this time about the definition of recession. Let's take a look at what the facts are. What's the textbook definition of recession?
Is the US economy already in a recession? Or will widespread fear of recession inevitably lead to the undesirable? And finally, can the US bring down inflation to 2% without hurting the labor market? These three questions are weighing on everyone's mind. As any suffering in the world's biggest economy will invariably send ripples, even shockwaves across the globe.
I think we will find that in spring of next year, the NBER will move to declare that the US is in recession. And the reason I say that is by then, I think we will have seen increased job losses. We will have seen a falling housing market. We will likely see the year-over-year rates of retail sales and industrial production moving into negative territory.
Ominously, most experts are quick to drop the R word, almost guaranteeing recession in newspaper articles and TV debates. However, declaring a recession is almost as difficult as predicting one.
If you see, given the uncertainty that we see in the world today, it would take a brave man to stick their neck out and say, okay, I'm sorry, I know Nick did say that we will declare a recession in the first quarter of next year, but it's much, much more difficult than that because there are so many moving parts. We really do not know if perchance the war in the Ukraine were to end, things would change dramatically. Who knew COVID would hit us?
The Atlanta Fed's GDP Now model has estimated a 2.1% contraction in the US economy in the second quarter of this year. If we were to take this data at face value, and the data has been highly reliable over the years, then the US has already technically entered a recession. Here's the catch. The traditional definition of recession has lost some shine over the years, as GDP alone cannot diagnose the health of an economy. Take, for instance, 2001's recession. A recession was declared even though the GDP did not decline for 2 consecutive quarters. However, the unemployment had risen to 5.5%. Nasdaq lost more than 75% of its value and industrial production fell. So who is the supreme authority on deciding what possibly nobody wants to hear? It's the National Bureau of Economic Research in the US that is considered the official arbiter of when recession starts and ends. Going by job numbers, the US is certainly not in a recession as the economy is adding hundreds and thousands of jobs every month. The unemployment rate is below 4%. This factor alone stands in the way of a recession. Industrial production too has been rising until May. Some economists observe the yield curve, but the gap between the 3 months and the 18 months wait has also not inverted. This is why most economists are suggesting that the recession, should it come, will be a mild one. With Gulshan Sharma in Mumbai, Stacey Pereira for ET Now.